Now let's have a look at some typical items you may find in your questions, and let's learn how to treat them. Suppose there is balance sheet and on asset side there is joint life policy of rupees 10,000 and joint life policy reserve on liability side is rupees 9,000. You know, joint life policy can be taken for the partners by the firm. If you find joint life policy item on the asset side, it means that is the surrender value of the joint life policy. So one thing is clear, that joint life policy is being treated at asset method. But if you find any joint life policy reserve on the liability side, it means the firm is creating reserve for the joint life policy expense account. It means the firm is taking a part of profit and creating reserve. So there are two options. In case of dissolution, if you find any joint life policy on the asset side, it should be immediately transferred to realization account. Means the journal entry will be realization account debit to joint life policy, and whatever we get in future from insurance company for the joint life policy, the journal entry in future will be cash account debit to realization account. But this joint life policy reserve, we have two options. First option is that it is transferred to realization account. So in that case, the journal entry will be joint life policy reserve account debit to realization account. Be careful, it is not treated as payable liability, means it is a non-payable item, no money will be paid in future. Generally, we assume if the question is silent about any liability, we safely assume that it was paid in full, but you won't pay anything in this situation because it is not an outside payable liability. And the second option is that this joint life policy reserve can be treated as accumulated profit, means as general reserve. And in that situation, the journal entry will be joint life policy reserve account debit to A's capital, B's capital and C's capital in the profit sharing ratio. I am assuming that there are three partners A, B, C. So it can be treated as other accumulated profits or reserves. In the same way, suppose there is a balance sheet and the firm is getting dissolved, and on asset side you find investment, and on the liability side you find investment fluctuation reserve. This investment must be transferred to realization account, and the journal entry will be realization account debit to investment account. Very simple, it will be transferred to realization account like other assets. But if you find investment fluctuation reserve on the liability side, there are two options. It can be transferred to realization account. In that situation, the journal entry will be investment fluctuation reserve account debit to realization account. Be careful, this is non-payable item, means you cannot assume that this money was paid by the firm in future if the question is silent. No. If you do this thing, means if it is transferred to realization account, it will create the profit in the realization account. And the second option is this investment fluctuation reserve can be treated as an accumulated profit, or it can be treated as general reserve and will be transferred to the capital accounts in the profit sharing ratio. So what will be the journal entry? Investment fluctuation reserve account debit to A's capital, to B's capital, to C's capital. In the balance sheet, you might find workman compensation reserve on the liability side. Generally, this profit or this reserve is created when the job is a bit risky for the workers in the factory and the firm has to pay for the compensation. So for that situation or to meet that emergency, the firm keeps on taking out the part of profit to meet that emergency. So there are two options. Either it can be transferred to realization account, it's a non-payable item. So in that situation, the journal entry will be workman compensation reserve account debit to realization account. So it will be transferred to realization account, but no money will be paid for this thing, and indirectly it will create profit on realization. And the second option is that it can be treated as reserve and can be transferred to capital account. In that situation, the journal entry will be workman compensation reserve account debit to A's capital, to B's capital, to C's capital. Next item is, suppose there is machinery on the asset side and machinery replacement reserve on the liability side. Sometimes some firms create reserves, means they take out the part of profits to replace the depreciable item. It can be created for machinery or furniture or computer, anything. So there is no question about machinery on asset side. It is always and always transferred to realization account, and the journal entry will be realization account debit to machinery. Very simple. But machinery replacement reserve on liability side, there are two options. Either it can be transferred to realization account like other liabilities, and the journal entry will be machinery replacement reserve account debit to realization account. But be careful, it's a non-payable item, means no money will be paid in future. So indirectly it will create profit on realization account, and that profit will go to capital accounts. And the second option is, you can treat it as a general reserve or accumulated profit, and that can be transferred to capital accounts directly. In that situation, the journal entry will be machinery replacement reserve account debit to A's capital, to B's capital, to C's capital. And on the balance sheet, sometimes you may find contingency reserve. It is just like general reserve. It is the part of profit and it is accumulated profit. So what will be the journal entry? Contingency reserve account debit to A's capital, to B's capital, to C's capital. Be careful, if you find current accounts of the partners in the balance sheet, it's clearly indicating that capitals are fixed in the firm. Though the firm is getting dissolved, at present there is no difference between current account and capital account. It all depends upon your teacher how he is going to treat it. But generally the best way is the capitals account should be transferred to current accounts and all the transactions should be routed through current accounts. But even if you start routing all the transactions through capital account, it's okay. And sometimes when you are studying some balance sheet and the firm is getting dissolved, on the asset side you find debtors, for example 10,000 in the inner column, and in the inner column you find provision for bad debts rupees 1,000, and in the outer column it is 9,000. Sometimes some students, they ignore 1,000, straightway they transfer rupees 9,000 to the realization account. That's totally wrong, because there are two items, rupees 10,000 and rupees 1,000. 10,000 should be treated differently and provision for bad debts of rupees 1,000 should be treated differently. So what should be the journal entry? Realization account debit to debtors rupees 10,000 and provision for bad debts account debit to realization rupees 1,000. And provision for bad debts has been treated as a liability. But be careful, this is not a payable item, means in future no money will be paid for provision for bad debts. And sometimes you may find provision for bad debts on the liability side, means debtors on the asset side rupees 10,000 and provision for bad debts on liability side rupees 1,000. So in that situation the same treatment will be given, means realization account debit to debtors rupees 10,000 and provision for bad debts account debit to realization account rupees 1,000. And one thing more, provision for bad debts, provision for doubtful debts, reserve for bad debts, reserve for doubtful debts, they all are one and same thing for the accounting treatment.